here in the U.S.
U.S. stocks are declining this Monday as investors sold following last week's advance.
But the question is, what'd you miss?
From bull to bear, Wall Street's most vocal champion on U.S. stocks over the past 2 years is now the biggest bear. Fundstrat's Tom Lee will discuss his recent about-face. Plus, will Trump's Fed take a hawkish turn? Potential candidates for chair suggest monetary policy would be tighter if they were in charge. We'll look at a Trump Fed with economist Vincent Reinhart of Standish Mellon. And auto CEOs are gathering in Detroit for the esteemed North American International Auto Show, where we've caught up with General Motors' Mary Barra, Ford's Mark Fields, as well as other executives from Audi and Mercedes.
All right, let's get you started, as we always do, with a check on where the major indexes are as we head towards the close. Abigail Doolittle has the numbers. Abigail?
Hi there, Scarlet. Well, we are looking at mixed trading for the major averages heading into the close. We have the Dow and the S&P 500 trading down ever so slightly, being held back by energy. But we do have the NASDAQ trading modestly higher, being helped by technology strength. In fact, carving out new record highs on the day. So not a lot of conviction here. But one thing that all three major averages do have in common is Apple. This is the biggest point boost for each of the major averages. Apple is actually up 4 out of the last 5 days. And today, this is a great fun fact, today is the precise 10-year anniversary of the introduction of the iPhone. It was on January 9th, 2007, when CEO, chairman, and co-founder Steve Jobs did say, when he unveiled the iPhone, that, quote, today Apple is going to reinvent the phone. And I have to believe, being one of the greatest visionaries of our time, that he knew that he was really leading the way for the smartphone. But, of course, it all comes down to revenue. We hop into the Bloomberg and we take a look at a great chart. This is #BTV 2244. It goes back 10 years. And in purple, in aqua, we have total revenues. We see back in 2007. You can't even see it from your view. There's only a slim margin of purple, which is the iPhone. But now we see last year the iPhone was more than 50% of total revenue. So the iPhone has obviously just been an absolutely huge blockbuster for Apple, and again, changing the path of technology and smartphones. And just a few fun facts around the iPhone itself. More than $1 billion have been sold since the introduction. Last year, nearly $140 billion worth of revenue came from the iPhone. Amazingly, this puts Apple 12th in terms of revenues for the S&P 500. But probably what stands out the most is the fact that since the introduction of the iPhone, Apple is up more than 800%, Scarlett and Oliver. Not so shabby.
Not so shabby. All right, Abigail Doolittle, thank you so much.
What'd you miss? Wall Street's bull for the past 2 years is now its biggest bear. Tom Lee, the managing partner at Fundstrat Global Advisors, now has a year-end S&P 500 target that's 3% lower than the median of the 18 strategists that we survey here at Bloomberg. So what's prompting his caution? Let's ask him. Tom, obviously, you know, we got pretty close to the year-end call that you had put about a year ago, the 23-25. Not quite, but we got pretty close. So a lot of these sort of doubters, you know, were proven wrong. But now you're the biggest bear. So say it ain't so. What's going on?
Well, I mean, and it's a relative term, right? Because we're not looking for a bear market.
Sure. We
just are below consensus in our views. And I think it's, look, I think this is a year where we have good economic, you know, recovery, like good earnings growth. But there's things that are going to hold the index back. I mean, one, I think the most important is, you know, credit and derivatives usually lead equities. The fixed income market is not as bullish as the stock market. And you can see it in the long-term yield curve. It's really flattened. If you think inflation's picking up and growth's picking up, the curve should be steepening, and it's flattening. The second is, you know, it's a post-election year. I mean, there's a lot of dynamics that come into play, but the first 6 months, 93% of the time, the market's down year-to-date in the first year after an election.
Is there a reason tied to that?
Well, I think so we look, N equals 29. There's 29 instances. So we looked at a bunch of them, and some of them have to do with like the fiscal thrust that occurs in the fourth quarter for local governments to get reelected. So there's payback. I think this year it's more about the inflation pickup has been in the labor market. So I think it raises the risk the Fed's making a policy error. And then lastly, you know, if you look at where earnings lift is coming from, it's coming from the 5 sectors we've highlighted. You know, with our theme acronym this year, CRAP. They're producing 10% plus earnings growth, but then the rest of the other 5 or 6 sectors, are talking about 1 or 2% earnings growth. So you're not really getting a lift from all groups.
What about deregulation? Donald Trump is going to dismantle some of the regulation from the last 8 years, and everything's supposed to take off. Won't all the companies benefit? And this is a great chart that you included in your note that shows that there was this huge jump in regulatory burden during the Obama term, and of course it typically goes up during Democratic terms versus going down during Republican administrations. Yes,
I think it's really important because we were really shocked. I mean, the last 8 years have seen the biggest jump in any administration, really, in 50 years. But when you look at, and we got some data from the Mercatus Institute, there's really 3 sectors that benefit the most: manufacturing, the banking sector, and energy. Those are all part of the CRAP call as well. So in other words, deregulation is going to help half of the S&P, but then, like healthcare, for instance, is on the other end of that. I think they face a lot of regulatory risk, more on the pricing side. So there's winners and losers.
The question that I have that is still tugging away here that I'm having trouble getting through, so hopefully you can help, is that we were talking about the bullish call throughout 2016, and a lot of what was behind that was what you called a, quote, Titanic shift into equities. So did the Titanic sink? What happened?
No, I think that's still there. I mean, I think what you have to remember is we're not turning bearish.
Right.
We're just the least...
less bullish.
Yes, but in this, in this environment, I think it is important to keep in mind that there's a lot of good things to be positive about, but we have to think about what could cause surprise. And like at the start of last year, people were really negative about oil and Brexit and the election, and it was very easy for us to craft the opposite argument and say, look, there's a lot of room for positive surprise. Now I think when we speak to our clients, and it's interesting, the feedback we've been getting is like, come on, Tom, what's changed? And we have a lot of pushback on the idea that the markets might not advance. I think most people think it's 10% or better.
Well, if we could go back to that regulatory burden chart for a moment there, because one thing I noticed is that, yes, the Obama administration represents the biggest jump in burden in 50 years, and higher highs through Democratic terms, but you also have higher lows through Republican terms as well. So do we presume that under Donald Trump, regulatory burden will still be higher than it was during W's term?
Yeah, well, you're going to naturally expect, because this is based on restrictive words in regulation. So as the economy grows, the number of restrictive words should just grow.
Got it. Okay.
So it's sort of like it's a linear relationship. But I think what's interesting is when you look at these charts, you can see the first term of a Republican administration sees a massive deceleration of that rate of change. So I think that's what we should expect is, we in our outlook, we really list some specific instances, but you can see tens and billions of dollars per year on industries from specific regulatory action. So as you can roll some of that back or mitigate it, I can see the animal spirits coming back for businesses.
And when you think about animal spirits, I think about some of the flows that we've seen post-election where you've seen money come into mostly ETFs, but a little bit of more improvement, I think, in the active management space as well. If we have an improving economy, which is what you're basically saying when you're painting the picture that the economy was probably going to be in a better situation, there's going to be more growth at least, doesn't that sort of encourage the retail investors, doesn't that kind of encourage the people that have not partaken in the market to come in and get invested? And if they do, buy assets just in general, what's better than to buy stocks right now?
Yeah, I mean, I'd say I agree with everything you just said. And, telecom, technology, banks, energy, the CRAP, they're at 13, 14 times earnings. I think they're going to re-rate huge on top of big earnings growth. But, you got utility staples, 19, 20 times. I just, unless you think there's a reason for them to go to 22 times, they're not going to really keep up. So I think you got puts and takes in the market.
One thing I've noticed is that all 3 benchmark indexes, the S&P, the Dow, the NASDAQ, all closed at record highs on Friday. And of course, the Dow's been the big winner among these 3. But outperforming them all has been the Russell 2000, which has not closed at a record high since last month, December 9th, I believe. Is the Russell 2000 a leader here or a laggard?
Well, I think the Russell is somewhat tracking the somewhat weaker performance in credit. So I think, again, I kind of feel like the message from the credit markets is they're definitely feeling better about the world, but not as optimistic as equities. And so, we've done a lot of work in the past. We think quality spreads so high yield, triple C, double B, have a lot of impact on small caps, and they're moving in sync. So there's some doubt being expressed by fixed income.
All right,
the Russell.
Yeah, and the Russell, yeah, indirectly. Yeah.
And for the record, your call for CRAP, computers, resources, American banks, and phone carriers. I think
That's how he got CRAP.
I think you could have gone with banks instead of American banks, but all right.
What would that be? Curba?
That's not as exciting.
All right, Tom Lee, Fundstrat, Global Advisors, Managing Partner. A little bit more bearish this year. Thanks so much.
Great. Thanks, guys.
Coming up on What You Missed, GM Chairman and CEO Mary Barra on fuel economy standards, as well as the electrification of sedans and SUVs. Her comments from the North American International Auto Show in Detroit. This is Bloomberg. What'd you miss? General Motors' Chevrolet Bolt was named North America Car of the Year at the North American International Auto Show in Detroit. Earlier today, Bloomberg's David Weston spoke with GM Chairman and CEO Mary Barra, who commented on what the honor means to GM.
We are very excited. It won North American Car of the Year, and I couldn't be more proud of the team. I mean, this is not an electric vehicle. It happens to be a great car that's also an electric vehicle. The features, the functionality, it's really a platform of technology, and the team was able to do 238 miles. We challenged them to 200. They got 238, did it in a shorter time frame, so it's a great car. I'm so excited.
And it's for sale now, as of early December. So you can buy these. You
can buy these right now, and we've delivered already to some customers in California.
And is there any track record now on how it's selling? How's it doing?
It's really early days, and as we look at, there's a lot of interest in the vehicle, but this is really just the start of the platform that we're going to use for electrification to go much broader and into much more different vehicles. So this is the jumping point.
So I mentioned the Traverse before. This is your new version of your crossover SUV from Chevy.
Yes.
You just revealed. The SUV has become so important, certainly to GM and your fleet, but more generally in North America. What is that about?
Well, I think part of it is people are on the go. I mean, we have very, very busy lives, and an SUV allows you to, really adapt to your lifestyle and have everything you need. This is launching the Chevrolet Traverse, rounds out a full Chevrolet SUV crossover and portfolio from the Trax to all the way to the Traverse. So it really is people saying, I want a car that really fits my lifestyle. And, one of the interesting facts is once someone drives an SUV, rarely they go back to a car, to a sedan. So, we're really focusing on that trend. We're very excited that we have several SUVs to roll out this year. We also just recently launched the Equinox, which is right in the middle. So we couldn't be more excited. We think, is a great new refreshed product portfolio for exactly what the customer is looking for.
So you're responding to consumer demand, obviously.
Absolutely.
It wouldn't work otherwise. At the same time, to be honest, it is somewhat more profitable for General Motors than some other automobiles might be. So it helps your bottom line. You make a lot of money off SUVs and trucks.
Well, SUVs and trucks are a very important part of driving profitability, but we work across the whole portfolio to make sure we have the right products that are also, warranting the investment in the capital. And that's something that we've been very disciplined about over the last few years to make sure as we make an investment, it's going to generate the right return.
So historically, one of the issues with SUVs and trucks has been fuel economy, because there are these overall fleet requirements for fuel economy and trying to make sure that you balance it with more fuel-efficient cars. Is that still the case? How is that evolving?
Well, the fuel standards have changed a bit, although, we're on our way to the 2025, although, the midterm review is something that we still need to look at and make sure that we're enabling to achieve fuel efficiency the most effective way. Otherwise, it's going to cost the customer from a bottom line perspective. But I would also say across our whole portfolio of SUVs and trucks, we have really improved the fuel efficiency of those vehicles as well. So we're trying to do both.
So there may not be as much of a differential in the fuel efficiency between the trucks and the SUVs and the regular cars.
Absolutely. We continue to use technologies, and perfect the internal combustion engine, light electrification, all with a goal to make sure that we have the most fuel-efficient fleet.
You mentioned the midterm, I think you call it, review that's coming up. I think that's this year, isn't that correct?
It's actually for 18.
18.
Right.
So what do you expect from that, particularly as we see a new administration coming in? Are you expecting some relief in that area?
Well, I think what we're really looking for is to make sure we have flexibility. One of the reasons I think they put the midterm review in is because technology would evolve, the marketplace would evolve. So we need to make sure that we're able to put vehicles into the marketplace that customers really want and do that as effectively as possible. So we're looking for flexibility.
That was General Motors Chairman and CEO Mary Barra. And in another great interview from the North American International Auto Show, Bloomberg's Caroline Hyde caught up with the head of Mercedes-Benz Cars, chairman of the board at Daimler, Dieter Zetsche. He talked about what to expect in the newest E-Class model.
We introduced a new E-Class generation last year, and it was seen by many people as the best vehicle in its segment. Now we are expanding with the family, and this is the new E-Coupe, which obviously provides all the technology, the comfort, the safety of the E-Class family. But on top of that, it has really a unique, beautiful dress, if you want. So we are very much focusing on the styling of this vehicle with a very sportive approach, at the same time very pure styling, and not on cost of functionality, because we increase the interior space, and you have even in the rear seats very comfortable seating. So we think that's a perfect mix between functionality, safety of Mercedes, and a beautiful look.
So powered in part by the E-Class, you took the crown in 2016, a luxury worldwide as well as the United States.
Absolutely.
Congratulations, first of all.
Thank you very much. Appreciate that.
Take us forward in 2017. Can you hold that crown? And if so, what will it take?
I mean, everybody knows that getting to the top is a difficult task. Staying there, probably even more difficult. But of course, that is our objective. And we think we have a good prerequisites by just continuing to do what we did to get where we are today, which means coming up with one great product after the other, which customers around the globe want to buy. And we see the new E-Class Coupe here. We have left of us a new GT version for AMG, and we're having many more cars coming this year and the years to come, which I do believe will maintain the great momentum we have built into our brand, becoming younger, becoming more relevant, cooler if you want, and still applying to our traditional customer base.
One of the things we've seen in the United States, but I think around the world, is a real shift from automobiles to SUVs and even trucks. Do you see that same shift within Mercedes-Benz? I mean, will the E-Class still power you, or do you need to go into your SUVs more heavily?
I mean, every manufacturer sees the strong demand for SUVs around the globe. Certainly in the US, the pickup is another element which is not that relevant in other parts of the world. But we have a very, very successful growth driver with our SUVs. We expanded the family of SUVs significantly, the portfolio, and this pace. And at the same time, when you talk about the absolute volumes, the sedans are still a significant chunk of our total sales volume, and therefore we do both. We come up with great new sedans, but we instill their hunger for SUVs as well.
Besides Mercedes-Benz taking the crown in 2016, we also had an election, presidential election in this country you may have heard about. And that has become quite a subject, particularly in the auto industry. Not only, but particularly in the auto industry. And we're focused much more on where automobiles are being made as opposed to just where they came from. So how does that affect Mercedes-Benz operation? I know you have an operation in Alabama, for example.
Well, first of all, I do believe that we should wait for inauguration date and then talk less about speculations, what might be, but more about facts the new administration will set and define. We have had good cooperation with the administration in the past, and we assume that the same will apply in the future. We have a very strong manufacturing base in the United States with more than 22,000 people working here. We are growing. We're having a plant in Alabama with a lot of investment in the past and ongoing in the future. So we are exporting the GLE into the entire world out of the US as the only manufacturing place. So I think we very much apply to what we heard so far. Right. But once again, let's wait for 2 weeks from now and then see where we go.
That was Dieter Zetsche, head of Mercedes-Benz Cars and chairman of the board at Daimler, from the North American International Auto Show in Detroit.
It is time now for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. Carlyle Group is preparing to raise an 8th U.S. real estate fund in the first half of 2017. That is according to people with knowledge of the matter. The private equity firm is planning to target $5 billion for the pool. Carlyle closed its most recent North American real estate fund, Carlyle Realty Partners 6, in 2015, securing $4.2 billion in commitments. French-based drug maker Sanofi says its window to make a deal to acquire Actelion is closed now that Johnson & Johnson is back at the negotiating table. Sanofi's global R&D president tells Bloomberg it respects the exclusive relationship that Actelion has right now with J&J. Sanofi had been in advanced discussions to buy Actelion. J&J reopened talks with the Swiss target last month. Luxury executive Bernard Arnault says he is considering expanding his operations in the U.S., including sites in North Carolina and the Midwest. That is according to Women's Wear Daily. The LVMH CEO met with President-elect Donald Trump in Trump Tower in Manhattan earlier today. 10 years ago today, Steve Jobs introduced the iPhone to the world. The smartphone is now the tech giant's biggest seller by far. Since then, Apple has generated almost $700 billion in iPhone sales, netting more than $130 billion last year alone. But the 10-year anniversary does bring some changes for the company. iPhone sales are coming off their first year of decline, with limited growth projected for the future. And that is your Business Flash update.
All right, up next, we'll take a look at some rosy predictions for the U.S. dollar as well as corporate capex going into 2017. This is Bloomberg.
what'd you miss? Let's look at the momentum in the U.S. dollar. So you've got two panels here. We're looking at the DXY, the dollar index, and while it's declined for a third time in 4 days, there is certainly some carryover in momentum from last year. Let's come over here, Matt, to the far end of the chart, and you can see that we've gained some momentum recently. This is the top panel of the DXY, so this is the price action. The bottom panel here shows the momentum, and certainly there is momentum building up. But what's interesting is the momentum there is not as robust as it was, say, in 2001, if we come here, when the dollar index also moved up, or even back in the 80s, when you could see the dollar index was at about 150 and the momentum was really, really robust. We have not gone there yet.
That is pretty interesting. I always kind of wonder about the momentum measures, whether or not you want to see them or you don't want to see them, because at one
time, contrarian, right?
Exactly. But I do think it's interesting because we were talking about this a lot. Maybe this kind of shows that, that sort of animal spirits as far as the dollar go are still not quite there. Maybe at least when you look back at some of these other peaks here.
Yeah.
I'm looking at where animal spirits are starting to build up a little bit, but nothing to get too crazy about either. This is capex right now for the S&P 500 companies. The purple line here is showing the monthly capex that they've been doing that has actually already happened. This is in billions. The white line is looking at what analysts are expecting for those companies going forward. So basically what you've seen here is a peak that hit around 2015. Two main points I want to get from this chart. The first one is that, yes, capex has come down a little bit, but relative to history, it's still very high. So when you hear people talk about companies not actually spending any on expenditures, it's not really accurate. What has happened is it's slowed down, and they've been adding more to buybacks and dividends and that type of stuff. What the white line here is showing is now this little bit of a tick up in terms of expectation, which is a big deal because while it still is high, I think that you're now seeing some companies and some corporate executives say that they do feel a bit better about what's going to be going on in the U.S. economy next year. Maybe they'll get out and spend some more money. Whether or not that's good or bad for stocks is unclear because buyback stocks do well.
Yeah, well, we'll see how it all shakes out. Certainly, we need to get some clarity from the new administration first. All right, the market close is next. The major indexes, well, the Dow and the S&P at least, retreating from their record highs. The Dow moving away from 20,000, but the Nasdaq notching yet another all-time high, up 0.25%. This is Bloomberg. Moments away from the closing bell. What'd you miss? The Dow Jones Industrial Average pulling back from the elusive 20,000 mark after getting closer than ever last week. I'm Scarlet Fu.
And I'm Oliver Rinnick, and welcome to our viewers who are tuning in live from Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
All right, we begin with our market minutes. The Dow and the S&P retreating from record highs, so the Dow not getting any closer to 20,000. The Nasdaq, meantime, making another all-time high. There was no real economic data today that moved the market. Consumer credit came out at 3 p.m., but it's backwards looking, and it's not a market-moving data point. Yeah, there really wasn't much. In fact, there wasn't a ton of volatility throughout the day either. It was kind of just a sort of quiet Monday back, I guess, in some sense. But you're checking out some particular stocks, yeah? Yeah, if you look at the IMAP Go on Bloomberg, you can really see the breakdown in sectors, and you have 8 out of 11 groups moving down. Actually, I wouldn't even say 3 groups moving up because materials was little change here. Energy stocks off by 1.5%. You can see all the red here in the sector, and none of the major names in the energy sector gained. In fact, all of them declined. Range Resources, Southwestern, each down by more than 3%. So that's noteworthy as well. In terms of the actual individual names that we're keeping an eye on here today, I wanted to highlight a couple of M&A names as well here because we've got UNH, which is United Health. It is buying surgical care affiliates for $2.3 billion in stock and cash. That's a 17% premium to surgical care's last close. You can see surgical care getting up by almost 16%, or I should say more than 16%. Ariad Pharmaceuticals is being taken out by Japan's Takeda for $4.6 billion. That's at a 75% premium. And a quick mention here of VCA, which is an animal hospital chain. The ticker here is WOOF, W-O-O-F. Love that. Candy maker Mars is expanding to pet care now, or it already had a presence in pet care, but it's expanding its footprint there. And it's buying VCA for $7.7 billion, excluding debt. And you can see here the annual revenue from VCA has just been pretty attractive there, and that might be one reason why a company like Mars is looking to acquire it. Yeah, no kidding. That actually sort of was one of the more popular stories of the day. Yeah, doggy dollars. Right. You can't go wrong with chocolate and puppies, I guess. It's a win-win there. All right, I'm checking out what's going on with bonds. Firstly, what happened across the pond in the UK. Just going to 10-year yields moved down a little bit there. That was just kind of the story throughout the bond market today. But bring it closer to home, let's check out what happened in the U.S., where not only have we seen some of the yields kind of moving down a little bit, we've actually seen some of the spreads breaking out. But there's just the basis point move today, moved down in yields both for the 2 and the 10-year. And then what I think is interesting, and I know that what Joe's been talking about, and we've all been talking about, is the next screen, which is basically what's happened in terms of the spread breaking out, where you look at 2 versus 10, and even 2 versus 30, which is where it really shows up. Of course, those the curve really steepened going into the election, and then after that, we've basically gone now in the opposite direction. Things are starting to flatten out a little bit. And Tom Lee of Fundstrat was just telling us that this flattening of the curve signals how the bond market is confused, a bit confused, at least when it comes to inflation, because it should be steepening if it sees inflation. All right, let's look at currencies. You mentioned the gilt. The pound slumping on renewed fears of a hard Brexit. Theresa May, in a TV interview, signaled that she is prioritizing reducing immigration over staying in the European single market. She also said she will unveil details of her Brexit strategy in coming weeks. We see the pound weaker versus all the majors except for the Korean won. If you look at a 3-month chart of the pound versus the pound fell below $1.22. It's now at its weakest level since October. And emerging market currencies also under pressure. The Korean won, for instance, down because of tensions between North and South Korea. And of course, when we're looking at that up arrow, it's the dollar gaining in value versus the won. The Turkish lira making yet another record low versus the dollar on debates on constitutional changes in that country. And all of that contributing to the 0.25% move lower in the MSCI EM currency index. It was a lot lower earlier, so it's come back a little bit here. You know, Scarlet, I was pretty myopic, actually, when I just said that it was a quiet day, because when you look at actual currencies in emerging markets, it wasn't the quietest day ever. And you know what also wasn't quiet was commodities. We had a little bit of excitement in the commodity space. Overall, I just want to take a look at the commodity index here for Bloomberg's BCom, because really you take it back towards July, we haven't really gone anywhere. We've had a few ups and downs, but when you think about a market that was very driven by oil for the past couple years, that just really hasn't been the case so much. I think there's finally a bit of placidity, if you will, in that market. And then you want to flip over real quick just to show that there was a
tiny bit of volatility intraday for crude. We had a little bit of moves down there. Obviously, basically, this is sort of a push back against the idea that production will be slowing as we had those rig counts in the U.S. Really not a whole lot has changed there, and so some ideas that maybe that will keep, some oil flowing despite some of the OPEC cuts and ability from some of the countries to actually stand pat to what they agreed to.
Yeah, it was an ugly day for crude oil for sure.
Yep.
Down almost 4%. Those are today's market minutes. What'd you miss? Fed chiefs or Fed policymakers are weighing how quickly to raise interest rates this year, as investors seem fairly optimistic that the president-elect can shake the economy out of its low-growth rut. Atlanta Fed President Dennis Lockhart said today, quote, "The economy today is well positioned for steadily improving conditions. It is less certain that it's positioned for a breakout to markedly higher growth on a sustained basis." Here for his assessment is Vincent Reinhart, chief economist for Standish Mellon. And previously, Mr. Reinhart worked at the Fed for 24 years. He joins us now from Boston. Great to see you, Vince. Thanks so much for joining us today. Following the latest FOMC meeting and minutes, your take on looking at the Fed is you should rely on the Fed signals, the Fed minutes, the Fed projections for any sense of what the central bank will do next. Why is that?
Well, if we were sitting here 1 year ago, we would be talking about the 4 policy tightenings in 2016. But what happened is they found things to worry about at each meeting until they about ran out of 2016 and had to slip one in December. So why do you think they'll do 3 in 2017? Events will probably intrude.
But here's the thing is that even whether maybe markets shouldn't or maybe investors shouldn't, read into it too much. But at the end of the day, if you look at what has been driving a lot of markets over the past couple of years, it has been hanging on the Fed's every word. Are we finally going to be moving past that if, it seems like most of the people we talk to, strategists, are kind of saying, hey, it's going to be maybe 2, maybe 3. And we think that's the expectation. There's not a whole lot of volatility surrounding it, it seems.
Yeah, that's the Standish forecast, that the Fed will probably deliver 2 quarter-point hikes, and the risks favor 3, assuming that there isn't some early personnel changes from the induced from the White House side. But even if we're fairly certain that's going to happen, there's still going to be volatility surrounding each of the 8 scheduled meetings, and we're going to hang on every word of Janet Yellen because they do have in the past shown a potential to surprise.
Right. I'm glad you acknowledged that. In the end, we will still be hanging on the Fed's every word. Where does Janet Yellen see full employment at? I ask because I wonder whether the definition of full employment changes now that we have fiscal stimulus looming.
So I think the short answer is Janet Yellen is not going to be called out on a single number. She has a labor market training in particular and recognizes that there's lots of different ways to assess the utilization of labor resources. Are we close to full employment? I would think most FOMC policymakers have said yes. Is Janet Yellen willing to test how low the unemployment rate can go before declaring that we're there? I think yes, too. Part of the reason we think that they'll only tighten 2 as opposed to 3 times is that Yellen is probably willing to tolerate a little bit of an inflation overshoot to find out just how low the unemployment rate can go.
So a follow-up to that, if Janet Yellen does probe the notion of full employment, as you put it in your note, what are the risks of doing so? What could be the backlash?
Well, if you've ever been probed by a doctor, sometimes it does hurt if they push a little too high. So, that the basic problem is that thus far inflation has been well anchored, and that inflation has moved very, very little associated with changes in resource utilization. Maybe it's nonlinear. Maybe people get concerned about inflation picking up and that inflation rises more quickly than anticipated. That's one possibility, but it's only a risk. And thus far, inflation hasn't been very sensitive to resource use, and inflation remains pretty well anchored. That's why the Fed believes it can move very gradually. Now, the good thing about having a really gradual path of policy built into markets is if you need to respond, you don't have to do much more than they expect for to get their attention.
Vincent, one of the most dramatic, I think, shifts really of the past couple of months is obviously we went from concern that the Fed was not going to hike quick enough to keep up with the growing economy to basically, well, how many times are they going to do it? What are you going to be looking for? What are the data points that are key to you in the first half of 2017 when we get this new Trump transition? People start to speculate on what he's going to do. How do you assess where the economy is going to go?
Yeah, you're absolutely right about the most interesting thing about Janet Yellen's tenure up until this FOMC meeting, which was that markets were always more dovish than the Fed's own rate guidance. And so the Fed really didn't have to do much heavy lifting to convince market participants to do something they didn't believe. Now we're getting to the point where markets and the Fed are about in sync, and you could wind up with a point where markets believe the Fed is behind the curve. That's really tough when you're a central banker because they're really questioning your credibility. In an environment with so much uncertainty about governmental policies, how much fiscal stimulus, what's going to happen on trade, environment, financial policy, the chance you get your forecast wrong is probably elevated. So what are we going to be looking for? We're going to look for how much resource slack is being worked down. We're going to have to be looking to see how it's received by the rest of the world. What happens to the exchange value of the dollar? Significant more exchange rate appreciation can significantly change the forecast.
All right, Vincent Reinhart, Chief Economist for Standish Mellon Asset Management. Stick with us because we're going to get your perspective on what the Fed might look like in 4 years under a Trump presidency. Who might succeed Janet Yellen? When might that happen? This is Bloomberg. I'm Courtney Collins. Let's get to Bloomberg's First Word News. Senate Majority Leader Mitch McConnell met with President-elect Donald Trump today at Trump Tower. The sit-down comes a day before the Senate begins confirmation hearings on cabinet picks.
The President-elect and I had a good meeting about the Senate agenda, which of course includes confirming the cabinet appointments, getting further down the road toward repealing and replacing Obamacare. We simply talked about the Senate agenda and how we're ready to get going once it gets down there.
Democrats are taking issue with the hearing schedule's quick pace because the ethics office says it hasn't received financial disclosure reports for some nominees. The Kremlin is echoing Mr. Trump's criticism of a report accusing Russia of cyber meddling in the U.S. presidential election, calling it a witch hunt. The declassified report from U.S. intelligence agencies released last week alleges President Vladimir Putin ordered a hidden campaign to influence voters in favor of Trump over Democrat Hillary Clinton. A Putin spokesman says the accusations have no substance. U.S. ethics officials have cleared Scott Pruitt, Trump's nominee for the EPA, to proceed through the confirmation process. In just 4 pages, Pruitt disclosed an investment portfolio valued at $420,000 to $1 million, held primarily in mutual funds, bonds, and state retirement plan. No date has been set for this confirmation hearing. And Mexico's newly appointed lead diplomat to the United States says his country will negotiate with Trump with, quote, intelligence and common sense. Foreign Minister Luis Videgaray was responding to criticism that Mexico has been too tepid in its reaction to Trump's threats to investment in the country. Trump is proposing to tax companies that make U.S. goods in Mexico and to renegotiate or scrap trade agreements. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Oliver?
Courtney, thank you. We're back here with Vincent Reinhardt of Standish Mellon. Fed Chair Janet Yellen's 4-year term ends in January 2018, and we're already hearing what the central bank may look like by that time. 3 of her potential replacements, Stanford's John Taylor, Columbia Business School's Glenn Hubbard, and former Fed Governor Kevin Warsh are saying they would pursue tighter monetary policy if they were in charge. All right, Vincent, what do you make of that lineup there? What do you think?
So it is a Republican administration, and those are pretty conventional Republican picks. In fact, John Taylor and Glenn Hubbard were talked about 12 years ago in the mix with Ben Bernanke. So that they're going to be on the top of the list. Kevin Warsh is a prominent commentator on Federal Reserve policy. He has the market background and is now at an academic institution out there at Stanford's Hoover Institution. So pretty conventional.
Pretty conventional, but Donald Trump is anything but a conventional politician, right? I mean, he has indicated that he thought that Janet Yellen and the Fed left interest rates far too low for too long. This was during the campaign. Yet, at the same time, we know as a real estate guy, he benefits from low rates and likes to take on debt. Yeah. So how do we square that with how we think he might behave?
Don't know exactly. If you look at the last, say, 70 years of Federal Reserve chair appointments, most of them were exactly the people you'd thought toward the top of anybody's reasonable list of potential Fed chairs. Every once in a while, a president picks a CEO type. Thomas McCabe and G. William Miller come to mind. Those generally didn't work out quite as well. And if you look at the cabinet appointments thus far, mostly conventional Republican picks, leaning toward those with more aggressive agendas. So it's pretty wide open. I would suspect, however, that the Secretary of Treasury and all his advisors and the economic advisors to the president are not really going to want him to roll the dice with the Fed chair nomination.
Vincent, how much risk sort of is there involved in this process? Because, I don't know, I think that if you look at the sort of trajectory that we're now on, at least where analysts expect us to be on, we were just talking about going, into a rising rate environment. QE has pretty much been, I think, at least right now, it's exhausted by many people's definitions. So does the new or old Fed chair, Yellen, or somebody new, does it really make that big of a difference if we've already sort of, if the only question is how quickly you raise, rates? Is it 2 or 3 times a year, or 3 times or 4?
I think it's going to matter a lot. And if you think back 4 years ago and then 8 years before that, people started obsessing about who would succeed Alan Greenspan and then Ben Bernanke 6 to 9 months before their due date. And so the same thing's going to happen with Janet Yellen. And the difference between 2 Fed tightenings and 4 Fed tightenings is material to a bond portfolio manager, and to whether or not the Fed stops reinvesting their mortgage-backed securities next year or 4 years from now really will matter materially to the mortgage-backed securities market. So lots of attention and lots of volatility generation possible here.
No matter who is Fed chair, whether it's Yellen, and you've indicated in your note that you don't see her staying on, or her replacement, communication is an area where the Federal Reserve could certainly improve. Do you think the Fed is intentionally trying to confuse or obfuscate when it comes out with its various signals on where it sees interest rates? I mean, you can look at the dot plot, for instance, dots go on the Bloomberg to get some sense of how projections are kind of all over the place when it comes to where Fed officials see interest rates headed. Is this the result of too many different imprecise communication tools?
So I think there are a lot of different communications tools. In some sense, Federal Reserve policy is the elephant in the room, and the 19 FOMC participants are blindfolded and decide to describe just one part of the elephant. The policy decision really is what the majority wants. The minutes describe try to describe what everybody talked about, so it's a much wider range of outcomes. The summary of economic projections is not the expected outcome, but it is the most likely outcome. And they're fine distinctions. And another important part is sometimes FOMC participants are actually talking to each other because they're trying to influence their colleagues in advance of the meetings, but we just happen to be eavesdropping. So that there's a lot of communications extraneous to the main message. Where do you think rates will be a year from now?
Vincent, connecting our two conversations, talking about the natural rate of unemployment. Trump has talked about how he thinks the economy really needs a boost, that it has been struggling. You look at unemployment, obviously that tells a very different tale. But then you look at Fed chair. How do you get a Fed chair to sort of corroborate what he said and make action based on that if you've already driven down, one of these major metrics as far as it can go?
Yeah, with an unemployment rate of 4.75%, and potential output growing something like 1.5%. If the goal is to generate aggregate demand growth of, say, 4%, then you're going to have to explain how you get that extra output. Do we suddenly have a productivity miracle and output per hour increases a lot? Or do a lot of workers come back into the labor force? Or are we going to allow a lot of immigration so that we can have foreign workers provide that extra output? I don't think the third thing's going to happen, but that's part of the arithmetic. And if Fed officials aren't convinced that that extra aggregate demand will be provided by extra aggregate supply, they're going to quickly get worried about pressures on demand.
All right, very interesting. We got some of that demand from QE, but not so much the supply. Vincent Reinhardt of Standish Mellon, fantastic conversation. Thanks so much.
Coming up, Uniqlo Japan reported a December drop in same-store sales, and its chairman, billionaire Tadashi Yanai, lost a staggering amount of his personal wealth, at least on paper. We'll show you how to get the data on that. This is Bloomberg. I'm Scarlet Fu. Let's take a deep dive now into the Bloomberg. You can find the following charts using the function at the bottom of the screen. And I want to start with China and its FX reserves, because that was data that came out over the weekend. And if you look at this, the white bars indicate the FX reserves. They've dropped now for a sixth straight month in December, now to 5-year low, will likely fall below $3 trillion in January, which has a lot of people worried. You can see, of course, the blue line highlighting the deterioration of the yuan, the onshore yuan. We've inverted it so that when the line goes down, the yuan is going down in value versus the dollar. There's a big debate, Oliver, over how significant the drop in the FX reserves is, because most economists, including the IMF, believe in a strong reserve balance. $3 trillion, a psychologically important number. Will China implement stricter capital controls? Yet, on the other hand, Michael Shaul of Marketfield Asset Management says that China's debt market is dominated by domestic issuance, and the People's Bank of China controls domestic liquidity. So the actual level doesn't matter as much, since China doesn't really rely on external flows as much.
Right. This is a pretty big chart. I mean, I think that this is obviously one of the biggest conversations with the Chinese economy, money coming out. And then it really also, I just love the way that it moves really just right in line with the yuan. So you can see that that sort of depreciation that we've seen, or the weakening rather, I should say, has moved basically.
Certainly correlation.
Tandem. Yeah, no doubt. All right, I'm going to be looking at Rich Go, which is a great function. I'm looking at Tadashi Yanai in particular. You can just go to his profile, then click on his billionaire profile. This is great. This is just a good way to sort of assess how much these guys are making and losing. And guess what? Today he's losing quite a bit. Over here is his net worth. This is based on Bloomberg composites of all his different avenues of wealth. You can see a massive drop off there, about $1.4 billion. That's down here in the news section.
On paper.
On paper, of course. This is due to a big Uniqlo slump today. And this is just, I love the function because it puts it into perspective. You can basically go to, you go to Gates, you can go to Buffett, you can really go anywhere. This will show you the wealth change. You can actually go back to the other index and look at whose wealth is changing the most, the volatility, and it's nice to imagine.
I like that part. Under background, industry, specialty apparel, yes,
right.
Because of Next, right? Source, self-made.
Right. That's an important one, because obviously you've got, the Walton kids on here, and so theirs is not entirely self-made, to say the least.
All right, and the ticker of his fast holdings, fast retailing, is 9983JP. Coming up next, what's behind the rise of populism that led to the victory of President-elect Donald Trump, as well as the Brexit vote? We're going to speak with Harvard professor of government Michael Sandel, get his take, his prescription on what progressive parties need to learn. This is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News. New York Democratic Senator Chuck Schumer is taking aim at the hearing schedule for President-elect Donald Trump's cabinet nominees. Schumer says jamming through the list when many of the nominees have never held similar positions makes no sense. Schumer says it's worth delaying to ensure candidates are properly vetted. Trump's son-in-law Jared Kushner will be named a senior advisor to the president. That's according to a person familiar with the matter. Kushner's attorney says he's working on a plan to step down as CEO of his family's real estate company to meet U.S. ethics standards. In South Carolina, prosecutors have rested their death penalty case against Dylan Roof and the Charleston church shootings. As he promised earlier in the trial, Roof, who is representing himself, rested his case without calling witnesses or presenting any evidence. Jurors are likely to begin deliberations tomorrow. And Cuba and the United States have signed an agreement designed to prevent and clean up oil spills in the Gulf of Mexico and the Florida Straits. The deal calls on both countries to establish a bilateral operations plan in the event of a spill or other pollution in shared waters. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Oliver?
Courtney, thank you. Let's get a quick recap of the market session today. I made the mistake of saying it was a quiet day earlier, but that was just in the localized world of stocks. It didn't do a whole lot. We closed down about 40 basis points on the Dow. Obviously
NASDAQ
still
at
near
record high.
highs. Yeah, the NASDAQ is there. The NASDAQ stayed in the green. Those small caps got hit as well. You looked at the bonds, and the bond space was pretty quiet today, but obviously we had a little bit of volatility in oil. We also had a little bit of volatility in some of those emerging market currencies. And then just some quick breaking news from Bloomberg interview. Eric Rosengren, Fed Reserve Bank of Boston, sounding somewhat hawkish, basically saying that the Fed is already running U.S. economy a bit hot. This is in a Bloomberg interview, and he said that fiscal stimulus could influence the Fed rate hike pace. And he's also urging the Fed to take up a balance sheet timing debate. And he's saying that a positive surprise could be inflation overshoot. So seeming like Rosengren thinks we need to get moving on the hikes, perhaps.
All right, and that upside possible surprise would come from, for instance, global growth.
There you go.
We'll keep an eye on these headlines from Eric Rosengren. What'd you miss? The rise of populism stems from political elites' inability to recognize genuine grievances. And those who interpret the election of Donald Trump or the Brexit vote as anger over globalization or racism against immigrants are missing the point. That's according to Harvard University's Michael Sandel. He writes in Project Syndicate, the populism ascendant today is a rebellion against establishment parties generally, but center-left parties have suffered the greatest casualties. This is mainly their own fault. So what do these progressive parties need to learn? Let's bring in Michael Sandel now from Watertown, Massachusetts. Michael, great to speak with you. You've identified a couple of issues, one of them being income inequality. There's a recognition of income inequality, but the prescription from the left always seems to be the same thing: better access to college, fighting discrimination. Is social mobility dead?
Well, social mobility is languishing. Providing greater access to college, greater opportunity, combating discrimination, these are all very important, but they're not sufficient. I think what the populist anger is about is a sense not only of limited opportunity, but a lack of social esteem, a lack of respect for the dignity of work. And that's something that parties across the political spectrum need to consider.
Well, explain what that means, because that's a pretty curious term. Talk about this sort of that kind of disdain.
Well, there are a couple of things. First of all, social mobility is stalled. Here in the United States, we've always been worried less about inequality than Europe, reassuring ourselves that because of the American dream, you can always rise, so we don't have to worry so much about how far apart the rungs on the ladder are. But what we're finding today is that social mobility is stalled. People born into the bottom fifth of the income scale, 70% will not even reach the middle. Only 4% will reach the top fifth. So simply assuring people that hard work and talent will get you ahead, that's beginning to ring hollow. And so I think both political parties need to take more seriously problems of inequality, but also how we regard success, or the lack of it. There's a kind of smugness on the part of those who land on top. And I think many working people sense this, that the work they do is not respected in the way it once was.
Right. I like the way you put that. And you say it's dangerous as well because this emphasis on seeking a fair meritocracy is flawed because the winners then interpret their own success as something of their own doing. It's a measure of their own virtue rather than perhaps their standing beforehand and luck.
Right. And there's a tendency, I think, today especially, for those of us who land on top to inhale too deeply of our success, to pat ourselves on the back and say it's really all our doing, it's all my doing. But the consequence of that is a tendency to look down with disdain on those who are less fortunate, those who are disadvantaged, because if we landed on top thanks to our own doing, what does that mean about those less fortunate than ourselves? There is something toxic in this way of conceiving our success solely as our own doing. So this is really a moral and a cultural attitude towards success that goes way beyond questions of jobs, way beyond even questions of equal opportunity.
Michael, when you look at sort of the failure, I guess, to grasp some of these concepts by the political elite and also just the elite in general, sort of the coastal elites, if you will, do you feel that in the past 2 months here after the election that the party that lost, the Democrats, has the left gone and revisited? Are they being introspective? Do you find that this is going to be a constructive sort of opportunity for them to learn?
I think it's an open question. I think the Democratic Party will be more likely to re-examine its assumptions since it's now out of power. It's been beaten pretty badly. We see this also with the Labour Party in Britain and other social democratic parties in Europe. There is a kind of exhaustion of ideas, I think, on both sides of the political spectrum. But the Democratic Party, being out of power, now has an opportunity to rethink fundamentals, what it stands for, what is its mission. And the first question I think it should ask itself is, why is it that the Democratic Party has really lost the confidence of its once working class base, going back to the New Deal?
And just to underscore that, to Democratic policymakers, it can often seem like poverty is either foreign or black. Larry Summers, when he was Treasury Secretary, said that he made trips to Africa, to Latin America, to the U.S. inner cities to review these anti-poverty programs, but he doesn't recall going to Akron, Ohio, Flint, Toledo, or Youngstown to consider the damage there. That's pretty telling. Should liberals, should these elites, should policymakers start thinking in terms of American borders when they look at poverty as opposed to globally?
Well, I think that elites in the U.S. and in countries, in democracies throughout the world, need to do a better job of listening, need to do a better job of listening to ordinary workers, people in the middle class, and not to assume that they, the elites, are on top thanks to their superior wisdom and talent and effort. I think part of the anger fueling the populist protest is a kind of rebellion against the smugness, the sense of disdain. And this is a legitimate grievance. This goes well beyond the legitimate concerns with the bigotry that also animates the populist protest. I think there has to be a better job of listening and learning by elites of both political parties.
Michael, there's one point that you bring up, which is that politics has lost the ability to inspire. And I think that's very interesting coming out of the Obama presidency because there seemed to be a lot of inspiration early on. He was adored by his base. A lot of people across the aisle liked him. He's the first black president in our country. There were a lot of things that signaled change, that signaled, I mean, that was his whole, mantra going in. What about his policies failed to keep that sort of inspiration and transfer it over either into, whether it's a Democrat or Republican winner?
I think that President Obama stirred hope and inspiration during his 2008 campaign, but failed to translate that moral and civic idealism into governing, into his presidency. And I think the reason is he became the captive of a kind of technocratic approach to politics that is rife in both parties, especially at the top. It's the tendency to leave values outside of public discourse and to try to govern mainly by working through various views about what will make the economy work well. Of course, it's important to make the economy work well, but that can't replace a debate in public discourse about values, about justice, about the common good, about equality and inequality. And that requires listening, and that requires deliberation across the society. It can't be delivered by technocratic elites. And I think that the technocratic managerial turn of public discourse in democratic societies in recent years is also part of what's created an emptiness, a hollowness that has been filled often by narrow, intolerant, angry reaction.
All right, telling it like it is. Michael Sandel, professor of government at Harvard University, joining us from Watertown, Massachusetts. Thank you so much.
All right, up next, back to cars. We'll hear from Audi America President Scott Keogh about the company's new concept cars at the annual North American International Auto Show in Detroit. This is Bloomberg.
What'd you miss? Audi is looking to push even higher into ultra-luxury with a Q8 concept SUV. Bloomberg's Daybreak America's anchor David Weston caught up with Scott Keogh, the president of Audi America, at the North American International Auto Show in Detroit. David started by asking him about how the automaker plans on luring luxury SUV buyers.
We call it a concept car, but the truth is we're going to make this car. It's going to come next year. And if you look at SUVs and what's evolved into them, first of all, these are the biggest segments in luxury now. That's what people are looking for. The second thing is they're no longer utility vehicles. These are proper luxury cars. So it's loaded with technology, loaded with performance, and it looks great as well.
So before 2017 is out, we'll be able to go in and buy one of these?
Yeah, I'll give you the exact date, but I'd say around 2018 would be a great time for this car to hit the market.
Okay, so let's talk about right now. You've also got the SQ5, which is just over your left shoulder here.
Exactly right.
Surrounded by people.
Yes, exactly. Believe me, it is back there.
Exactly. So this is a crossover that you have. Now, this is available as the day. You announced this today.
We announced it. It'll hit the marketplace in April of this year. And this vehicle, of course, is the biggest segment in luxury. It's 25% of the luxury market. Its sister vehicle, the Q5, will be hitting the marketplace in April as well. And this is the sporty version, SQ5. So it's a really good machine.
So between the Q8 and the SQ5, you have an SUV story here, which is playing out across the country as people increasingly buy either an SUV or a truck, frankly, instead of an automobile. Does that trend continue into the future, do you think?
It does. I mean, if you look at it this year, the mix of SUVs went up 7% in luxury. 54% of all luxury cars are SUVs. When we look to the future, we think it climbing to over 60%. And why is it happening? People like this body style. Gen Y is forming families, and they're used to SUVs. And frankly, you don't have a compromise. Fuel economy is relatively the same. The packaging is good. So we don't see it going backwards, regardless of fuel prices.
So one of the things that you're really moving forward on is artificial intelligence, NVIDIA. You just came from CES, right?
We did, that's right.
Tell us about what you're doing there and why.
I think the first thing is we believe in autonomous and piloted driving. We've been the innovators. We've been doing this since 2005. We've driven from Stanford to Las Vegas. We've taken the lead. But the truth of the matter is what we're finding out is when you get out there in the real world, it is complicated. So if all you use right now is just cameras and sensors and LiDAR, and you have to use basically computer software. And computer software, what you need is endless. If X, then Y. If X, then Y. You'll never deal with all the complexity on the road, and that's why you need artificial intelligence. Take the machine learning of thousands of vehicles over millions of miles and all that intelligence and put it into the car. Well, so that's the way to get there sooner.
It may not be thousands of vehicles, but you're going to be really doing some real-life experimenting out in California. Put these cars in people's hands.
Exactly right.
When does that happen? How big is it?
I mean, look, we're going to start to test these models probably starting next year to gather the intelligence. We will be the first with artificial intelligence with what we call a level 4 autonomous, and that will happen in 2020. But again, there's no way to get autonomous safer and sooner without artificial intelligence. It won't happen.
So a lot is going on in the car industry, without a doubt.
Amen.
There's also a lot going on across the country now with the new administration coming in.
A little bit.
Yes,
a little bit.
Donald Trump got elected. So as you look forward into 2017, if you got to write your list of policies that you would like to see this administration adopt that would help your business, what would it look like?
Look, you know, I don't get into speculation, and obviously I'm not a politician, I'm a businessman. The biggest thing what businesses love is stability. And I think if you look at the U.S. car market, it's had record sales. If you look at the U.S. consumer, they've never had better cars at better pricing. So what we like is stability. We will deal with whatever playing field is out there. We'll compete just like every other company, but stability is the number one thing.
Well, one of the things that is out there right now is a lot of pressure being put on some automobile companies to manufacture in the United States rather than in Mexico or overseas. Audi does not produce in the United States. Does that put you in a particularly vulnerable position?
Look, we're a global manufacturer, and we make cars all over the world. We make these cars in Bratislava, we make these cars in Spain, we make these cars in Germany, and obviously we ship them all over the world. So as it's negotiated and as it exists right now, it does not. But of course, we'll brace for whatever comes our way.
Would you consider investing in the United States?
Always. And look, I think you have to be clear. We have 13,000 employees in America. We have dealerships. Almost, 80% of those are dealerships. So we are invested in communities. We are invested in our dealerships. And yes, we do believe in investing in America.
So finally, Scott, you had a really good year. Another really good year, if I may say. You're up in sales almost 4%, I think, globally. Right. What is it going to take to have another good year, to continue to grow in this year, 2017?
Well, honestly, I think we can do it. We did have a record year, our 7th in a row, and I anticipate another record year in 2017. The biggest reason, honestly, is all of the new products that are coming. The new Q5, it's a big segment. We have the A5, S5 Cabriolet that's here, as well as the Sportback. So we have a strong brand, and we have new products. So it gives me confidence we're going to grow, but of course, we're going to maintain our business model. Incentives, inventory, mix levels, get it right. But I still think we'll grow. I feel good about it, very good about it.
And that was David Weston's conversation with Scott Keogh, president of Audi America.
Another auto CEO you don't want to miss, Ford President and CEO Mark Fields, on what's new under the hood of the most popular truck in the U.S. That's the Ford F-150, of course. That plus plans for a hybrid version on the horizon. This is Bloomberg.
What you missed, Ford's decision to cancel that car factory in Mexico was seen as a political victory for the president-elect, as well as a victory for U.S. workers who will benefit from Ford's decision to add jobs in the state of Michigan. But at the site of the plant in Mexico, it was a very different story, with workers expressing their disappointment.
We had a machine rented, and 2 days ago they told us we have to remove it because the Ford project was canceled. We came over to see what was the situation yesterday, and indeed, the other contractors were taking out their machinery.
So let's get more on the situation. Joining us now from Mexico City is Victor Hugo Michel. He is editorial director of El Financiero Bloomberg TV. Victor, you visited the site of that plant. Tell us what you saw. Describe what it looked like.
Hi, Scarlet. Well, we could say that this is a very uncertain situation for the state of San Luis Potosí. This is in northern central Mexico. This is a place where the plant was going to build. We sent a team of reporters there to see what we could find. And basically what we came up with was a lot of uncertainty, a lot of long faces. The state of San Luis Potosí was basically expecting to boom with this plant. This was going to be the biggest deal in the state's history. GDP was going to skyrocket. That's what they were expecting. And now they're left with a lot of uncertainties. A lot of companies had already moved to San Luis Potosí. They were going to feed the Ford plant. That's not going to happen now. You saw what one of the contractors was saying. A lot of contracts are being canceled at this point. The same with a lot of workers that had moved into this part of the country. They were expecting work with the Ford company, and now what's left is basically an empty shell. The building, the factory was already being built, and now it's just going to stay there like, I could say, like a carcass in the middle of the desert.
Okay, Victor, I want to real quick, we've got a soundbite here from Mark Fields, the Ford CEO. Let's hear what he had to say.
We've had very good working relationships with every administration and policymakers through the years. And what we'd like to see is free and fair trade agreements. We want to see regulation and regulatory policies that are more reflective of market realities. And we really want to see corporate tax reform. I mean, here in the U.S., amongst developed nations, we have the highest corporate tax reform, and we think that would be good for the economy.
Victor, so there it kind of sounds like Mr. Fields is making it seem as if it's business as usual, but as we know, Trump has definitely already sort of targeted specific companies. Are people in Mexico worried that this is going to be something that doesn't go away anytime soon?
Indeed, this has been the main topic, the main discussion topic, politically and socially in the past few days, in the past few weeks. I could say that the past week was really a nightmare for the Mexican government when we saw what Ford announced, the canceling of the plant, and then we saw this unsettling announcements by Nissan, by Chrysler. Chrysler just said today that they might rethink their investments in Mexico if President Trump imposes a tax on the border. So this, you can imagine, is creating a lot of, I'd say, uncertainties here in Mexico, and maybe we're just starting to edge toward panic, because we don't know what's going to happen. There's a lot of investments that might just evaporate. What happened to San Luis Potosí is one of the best examples. The state was hoping to basically increase its GDP, and now they're thinking maybe about a recession next year. So that is one of the scenarios that we might be facing here in Mexico. Situation is really complicated at this point. I could say that the political establishment here is starting to get worried. I could tell you something else. Maybe you remember Luis Videgaray. He used to be the Mexican finance minister. He was sacked when then President or candidate-elect Trump came to Mexico. You might remember that situation when he came during the campaign. Well, he was just reinstated as the Mexican foreign minister because the Mexican government is thinking that his good relationship with Jared Kushner might, and I have to emphasize, might save us from the brunt of this Mexico-bashing politics that have been announced by President-elect Trump in the past few weeks.
Interesting twist there. Thank you so much. Victor Hugo Michel, editorial director of El Financiero Bloomberg TV, joining us from Mexico City.
All right, coming up, what you need to know to gear up for tomorrow's trading day. That's next. This is Bloomberg.
What'd you miss? Well, if you were only focused on equities, you only missed the NASDAQ closing at a record high. The Dow and the S&P 500 moved in the other direction. But the other asset class is a lot more interesting.
We did. Oil obviously had quite a bit of a slide today after some rig count numbers that basically showed the U.S. is going to keep pumping a lot of oil. And then that brought down the market as well. That was really what weighed on the stocks. It was those energy names. Commodities didn't do so hot either.
And don't forget emerging market currencies as well. The Turkish lira making yet another new record low.
Yep.
All right, in terms of what's coming up, speaking of emerging markets, China releasing CPI and PPI data at 8:30 p.m. Eastern time tonight.
And I'm looking at U.S. wholesale inventories released tomorrow at 10 a.m. Eastern time, but also NFIB small business data. We've also got JOLTS, too.
Don't forget that. All right, and don't miss this. Ending it where it began, President Obama giving his farewell address in Chicago at 9 p.m. Eastern time. It will take place again in Chicago. A primetime speech by the current president. Soon to depart.
I'm sure he'd like to be handing it off to someone in his party, but bittersweet nevertheless.
All right, that does it for What You Missed. Thanks for watching, everyone.
Have a great evening. This is Bloomberg.
I'm Heidi Lu and you're watching Bloomberg Technology. Let's get you started with a check of your first word news. Well, Senate Majority Leader Mitch McConnell says he's hopeful that a half dozen of President-elect Donald Trump's cabinet picks will be in place by day one. The first hearing for nominees is tomorrow. Democrats have complained that the hearing schedule is too rushed. Federal ethics officials have cleared Scott Pruitt, Mr. Trump's nominee for the EPA, to proceed through the confirmation process. Pruitt provided a 4-page disclosure of an investment portfolio valued at between $420,000 and $1 million. Meanwhile, Trump's son-in-law, Jared Kushner, will be named a senior advisor to the president. That's according to a person familiar with the matter. Kushner is said to be working on a plan to step down as CEO of his family's real estate company. Well, prosecutors have rested their death penalty case against Dylan Roof in the South Carolina church shootings. Roof, who is representing himself, rested his case without calling witnesses or presenting any evidence. Deliberations could begin tomorrow. And the U.S. Agriculture Department says the estimated cost to raise a child in the U.S. from birth until they turn 17 is more than $233,000. That's about $14,000 a year. Costs are up 3% from the previous year.